The long-awaited CPI data is due out November 10th. The consensus estimates are 7.9% year over year and core CPI 6.5% year over year. However, the Cleveland Fed is forecasting a much higher rate at 8.1% year over year and core to be at 6.6% year over year, much higher than the consensus estimates. But in this video, I'm going to be telling you why there could be an epic shock to the market if inflation comes in higher than both of these estimates here, and there's a good chance that it will. We're going to be drilling down into the price of lumber, energy, certain food items, what rent was like in October, as well as home builders ETFs to try to gauge whether there's a possibility that inflation will come in higher than expected. And if we take a look at the VIX, you could see that there are a ton of bets here on VIX calls. VIX is the volatility index, but there are a ton of bullish bets on volatility going out to the November 16th expiration and not many at the November 9th expiration. This shows us that the market is actually betting on volatility for CPI and not volatility for the midterm. So we will get into all of that. And towards the end of the video, I'm going to be giving you one or two plays on how I'm going to be hedging against a potential higher than expected CPI reading, which is very possible. I'm going to be telling you right now before we even jump into the data. So without further ado, let's get right into it. Okay, so let's take a look at the CPI expectations from Bloomberg's dataset. We could see that the consensus estimate is 7.9% year over year. This is down from an 8.2% reading that we saw in September. And core CPI, which strips out energy and food, is expected to be 6.5% compared to the 6.6% that we saw in September. Now, before we dive into the actual data, because we have what the commodity pricing was in October on a lot of these commodities, and we can kind of gauge whether inflation is expected to come in lower than consensus or higher or somewhere right around there. However, just keep in mind that 10 out of the last 12 consensus CPI readings actually came in hotter than expected. And if we take a look at the Cleveland Fed forecast, this also comes from Bloomberg's dataset, you can see that they are expecting a higher level of inflation than the consensus, 8.1% year over year, so not below that 8% threshold, and core inflation to remain at 6.6% year over year, the same as September. And here's another rub with this data. 16 of the last 19 times, inflation has come in even hotter than the Cleveland Fed's expectation. So not only hotter than the consensus expectation, but even higher than the elevated estimates of the Cleveland Fed. And if we take a look at the VIX is the volatility index. It basically gives us a measure of how market makers are betting on volatility or hedging using volatility going into certain binary events. And in general, you tend to see an elevated VIX before major binary events. However, November 9th, which is the expiration date that would coincide with midterm elections, you can see that there aren't actually a lot of plays on volatility on the VIX, meaning that institutional investors and traders aren't hedging for the midterms at all. However, November 16th is the expiration that coincides with the CPI reading that comes out November 10th. This is the closest expiration to the CPI reading. And you could see here that we have hundreds of thousands of calls on the VIX. You could see that even going all the way up to 70, we have 225,000 calls on the 70 strike price for the VIX. We have 290,000 at the 60 strike price for the VIX. And then when you get to the more realistic levels, you could see that today there are just a ton of calls open, 24,000 at the 35 level, 13,000 at the 32.5 level. And currently the VIX sits at around 25, which is really characteristically low before a CPI. Before the last CPI, the VIX was hovering around 30. I will likely be buying these 35 calls on the VIX, especially since they are down today. This is a hedge against my portfolio in case we see elevated levels of inflation. Now, I'm not saying that it's a certainty. We're going to be diving into the data here in a second. We're going to be looking at lumber, home builders, etc. I'm not saying it's a certainty, but this is a hedge based on the fact that inflation comes in hotter than expected most times. And when we start taking a look at the data that I'm about to show you, I think there's a good chance that it can come in either at expectations or even hotter than expected, because remember, we are measuring backwards for October. So we will dive into that data, but I will likely buy these 35 calls on the VIX They are relatively cheap, between 22 and 25 cents. And if you want access to all of my plays in real time, check the link in the description. We just opened up spots for November, and those usually go pretty quick. So book a free call with our team if you want to apply to the academy. You get access to the stocks, options, futures alerts, all of our analysis, the options course, the day trading course itself, and of course, the regular Zoom calls with me where I address all of your trading pain points, answer your questions, etc. So let's take a look at the commodities pricing by month. If we take a look at lumber, you could see that for October, lumber is up 7.5% after being down for a few months before that. It actually ticked up in October. If we take a look at oil, what did oil do in October? And for those of you that are in the XLE play, as well as some of the other individual oil stocks, you're probably really happy at the moment, but that's besides the point. Oil is up almost 9% in October. Let's take a look at live cattle futures. And yes, there are futures for live cattle. This is one of the food items that we track. But if you take a look at October, it is up 6.5%. Let's take a look at home builders. This is a home builders ETF, and you can see that the home builders ETF is up 6.5% in October as well, and that probably coincides with the higher price of lumber. And if we take a look at rents, this is actually a significant part of the CPI. But in October, there's a Bloomberg report that came out saying that more than a third of U.S. small businesses couldn't pay all of the rent in October. And that for small businesses, at least, it looks like rents are increasing. If we take a look at the larger picture for residential rents, you could see that year over year, rents are still growing. I expect to see a lower month over month number for rents, meaning that October rents are going to come in most likely less than September rents. But year over year, they're still up, right? And we're looking at that year over year number when we're looking at the consensus and the Cleveland Fed estimates. And if we take a look at the CME Fed Watch tool, you could see here that for the December FOMC meeting, this is the next time that the Fed meets, that it's split down the middle almost 50-50 between a 50 basis point rate hike, which is here on the left, and a 75 basis point rate hike here on the right. If you'll recall the last FOMC meeting, the Fed was actually extremely hawkish, not giving any indication on when they would stop. Jerome Powell actually said that there is no risk of over tightening, that the bigger risk is actually loosening too early. I did a whole video on that, so check that out here. But I expect this number to change drastically after the CPI report on Thursday, which we will be live streaming, by the way. If the CPI comes in lower than expected, then I think that this 50 basis point rate hike column will actually increase, and this one will decrease, and vice versa will happen if CPI comes in hotter than expected. Because if it comes in hotter than expected, so remember, 7.9% for headline, 6.5% for core. If it comes in hotter than this, then you can expect the Fed to absolutely go apeshit in December. And, all the talks of slowing down or pausing or whatever will be a moot point, because they will have no choice but to keep on with their foot on the gas pedal in order to try and fight inflation. So very interesting to see what's going to occur on November 10th. Again, we will be live streaming, but I do expect the markets to absolutely get spooked by a higher than expected inflation reading. Now, we are really in the middle of this descending wedge here, and we will be doing TA Tuesday, TA Thursday this week as well. So I will be going over this more in depth. Subscribe if you want to get notifications to those videos when they come out. But we are dead in the middle of this channel, which tells me that the market is really awaiting some of these huge binary events to decide where to go. Because if inflation actually comes in lower than expected, then in my view, we will be heading to this 400 level on the SPY that I had marked out a few weeks ago. And if not, then I think we will be headed towards the pre-COVID highs finally, which is around 340 on the SPY. But yeah, after 475 basis point rate hikes in a row, if we come in higher than expected, I mean, that's going to cause the market to lose a ton of confidence, because the Fed has really been ratcheting it up. And, if we come in higher than expected, then it will show that inflation is a lot stickier than we thought. And the Fed will actually have to be extremely aggressive. And you can also probably see bond rates soaring if the inflation comes in higher than expected. You can expect bond rates to soar. If inflation comes in lower than expected, I think you can expect bond yields to drop, as bond investors will likely pour into bonds, not expecting much higher rates in the future because they're going to be expecting that the Fed is actually going to slow down somewhat coming in December, probably more so on the 50 basis point rate hike or below, if inflation actually comes in lower than expected. Now, I actually started buying into the 2-year T-note futures here as the 2-year note hit a high of over 5% last week, and you saw those bonds get bought up really quick. And again, I expect if inflation to be lower than expected, bond yields to actually drop and bond investors to pour into bonds, which would increase these futures on the 2-year note. So for me, this is almost an optimal play here. I wouldn't play this if you are a risk averse trader and you don't want to play binary trades. But, again, if inflation comes in lower than expected, you can expect this to soar, in my opinion. If it comes in higher than expected, then I would expect bond yields to continue going up and bond prices to actually tank. So it is kind of a risky play right before CPI. But I think we're at the point here where I can continue to dollar cost average slowly in these 2-year notes. And of course, you don't have to play leveraged risky futures. You can actually buy the Treasury notes themselves. I mean, the 2-year is still paying 4.7%. You can't get this anywhere, not in a money market, not in a CD, not in your savings account. The 1-year is actually paying more, almost 4.8%. And if inflation comes in higher than expected, you can expect these yields to actually go up. But bonds are starting to look attractive for those that don't want to participate in risk on assets and are looking for a way to park their cash and not get obliterated by inflation. Anyway, traders, that is it for this video. Let me know what you think CPI is going to do on November 10th. Remember, we will be live streaming as usual. So leave a comment down below. Let me know where you think inflation is going to be headed. Is it going to come in higher than expected, lower than expected? Let me know if you started buying into treasuries or not. Are bonds looking attractive to you at the moment? Hit that thumbs up if you got anything out of this video. Subscribe to the Academy for all of our real-time alerts and analysis. Link is in the description below. Stay safe out there, traders. Peace.